If you work for yourself, it may be hard to figure out the best method to pay yourself from your company. If you pay yourself, a few usual questions come to mind. Do people still think of you as a worker? Should you receive a wage, or is there another improvement method of compensating yourself? How do taxes work on all these finances? We're delighted to respond to all these great questions, so let's get into it. There are 3 methods to pay yourself if you're self-employed. Number 1, salary. You do not want to work unpaid. Therefore, as a company owner, you need to know how and when to pay yourself. The very first way is to get a salary. Most of the time, the income method is most appropriate for companies set up as S-corporations. With this strategy, the salary for self-employed people looks similar to the wages of any other worker. You or your salary service will give you a paycheck every week. Payroll taxes will be taken out as usual, and you'll receive a W-2 at the end of each year. Number 2, owner's draw. The owner's draw is just another way for a business person to get paid. The draw is an excellent way to get paid in partnerships and sole proprietorships. In simple words, a draw is cash you can take from your company at any time and in any sum you would like. This works because sole proprietorships and partnerships are called pass-through entities. At the end of each year, the company's revenues are taxed to the owner since that money is owed to them. Pass-through entities are different from distinct entities that corporations make. You control all the money and can get it at any time. Also, if you own an S-corporation, you cannot take a draw from it. There are even so 2 essential things to bear in mind. The first point is that whatever funds you take out of your company can't be used by it anymore. You must ensure that your company has enough funds to pay its expenses and develop so it can continue to do well after your exit. The second point is related to working with other people. In a partnership, more than one person works on and owns a portion of the company. Each time you provide money, machinery skills, or something else to the company, you boost your ownership stake. But you must be cautious when you take a draw because it can't be more than your maximum owner's equity. Number 3, distributions. The IRS thinks you are an investor employee if you have an S-corporation. You have the same right as other shareholders to get dividend payments or other payments that your business pays out on its shares. This is great news because it means that if you work for an S-corporation and are also an investor, you can get both a wage and dividend income. This gives you 2 ways to make money. Is not it great? Now let's discuss S-corporation salary rules. Possible tax breaks. Owners of smaller businesses like S-corporation because it helps them save money on taxes. As the holder of an S-corporation, you'll be required to pay self-employment tax on any income you get from your company. Like numerous other company owners, but here's the best part. You are not required to pay self-employment tax on dividends you give yourself. This indicates you'll be able to keep some of the money you make throughout the year without paying self-employment tax. This can save you a lot of money when it comes time to pay your taxes. The rule for a reasonable salary. Before celebrating your lower self-employment tax bill, you should know a few things. The IRS would then allow you to get away with not paying a few of your self-employment taxes, but it won't release you from the hook completely. Under the reasonable compensation rule, S-Corp owners must pay themselves a fair salary. What's reasonable? That is going to depend. When figuring out a fair wage, you should consider the amount you would make if you did the same job for another person in your region. Think about what you know, what you've learned, and what you've done. If you have staff members, you should also assume how much you pay them. As the owner of the company, it might not seem logical for you to earn the same salary as your office manager. The 60-40 rule for S-Corp salaries. This is not a strict and unchangeable rule, though. The IRS does not follow or even acknowledge the 60-40 rule. But CPAs and other tax experts have been using the S-Corp salary 60-40 rule for a long time. Under this rule, you probably won't get in trouble with the IRS if 60% of your revenue during the year comes from salary and the remaining 40% comes from dividends. If your company isn't making that much money, you can change this formula and your wage without worrying about getting in trouble. Once things start to get better, make absolutely sure you use this principle or another suitable method to figure out your income. And if questioned, have evidence to back up the salary you prefer. Information about tax withholding. No matter what kind of payout you choose, you need to know how tax withholding works and doesn't work. If you receive a paycheck from an S-corporation, payroll taxes are taken out, just like when you work somewhere else. Draws and dividends are not like this, though. Taxes aren't taken from these payouts. Therefore, you'll have to pay the tax on them towards the end of the year, or if you assume to owe a lot, make estimated tax payments during the year. It's crucial to understand when taxes are taken out and when they are not because it can significantly impact when it's time for taxes. If you're not getting a salary but consider getting a lot of dividends or a draw, you might want to increase the deductions from your weekly wage to minimize the tax you will owe on April 15th. Forms to fill out for taxes. As a company owner, you have to tell the IRS and the individuals who received salaries, draws, and dividends what you paid them. You'll also need to include these earnings on your tax return as a taxpayer. All of this could add up to a lot of documentation, but here we'll break down which forms you require depending on the business entity you're running. Single Member LLC. As we've already said, single-member LLCs are pass-through entities, which mean that all of their income is yours when it comes time to pay taxes. As a sole proprietor, it's up to you to track how much money you make and how much it costs you. If you did more than $600 worth of services for a customer, they must send you a Form 1099 that shows how much they paid you. If you don't do it, you're entirely on your own. At the end of the year, you'll collect your 1,099 forms along with your own documents and fill out a Schedule C to disclose your revenue or loss. Schedule C will instruct you to record your earnings and expenses, add them all up, and afterward, tell you precisely what to write on your Form 1040 tax return. The S-Corporations. S-Corporations also have to fill out their own documentation. Don't forget that you have to get paid by your S-Corporation. So your company will have to give each worker a Form W-2 with their pay information. It will also be required to send the Social Security Administration a Form W-3. Your state and city governments may need you to file more payroll tax returns. The S-Corporation should also send the IRS a Form 1120S. This return is equivalent to one that partnerships have to file, so each investor gets a Schedule K-1S. The Schedule K-1S tells each shareholder what percentage of the business's earnings or losses is theirs. We're almost done, but not completely. Form 1099-DIV reports should also be made and filed by the S-Corporation. This form is used to notify any dividends are paid to stockholders. It is provided to the IRS and even stockholders. As an employee and taxpayer, your company will send you a W-2, a Schedule K-1S, and maybe even a Form 1099-DIV. On your Form 1040, the data on your W-2 is revealed as wages, as standard. Disclose the data on your Schedule K-1S on a Form 1040 Schedule E and treat the dividend payments on your Form 1099-DIV as capital gains that you report on a Schedule D. As you can see, it can be challenging for a company owner to determine how to pay themselves. Owning your own company can be very beneficial, but it may also result in a lot of tax decisions and documentation. Mulai Law is here to assist you with both of these. We can help you figure out what kind of payouts will perform effectively for you, while also guiding you through each of the reporting requirements you and your company need to meet. Even if you're new to this or an experienced pro with a small question about your existing tax filing, we're delighted to assist you in overcoming the hurdle so that you can get back to concentrating on your primary business. Thanks for watching. See you next time.